morning, good evening, everyone. And of course, it's good to be back with so many friends, looking across the names and some faces. Glad to see that all of you are have endured this tragic pandemic and are with us once again. It's also good to be moving away from discussing the virus once again to discussing bread and butter issues of all of us who care about India, such as the exchange rate regime, whether we're overvalued, undervalued, etc. We had these big fights in the past, time to have them again. So good to have two experts today on this issue, followed by two very prominent discussants. So let's start with Rajeswari Sengupta, who's going to talk about analyzing India's exchange rate regime. This is joint with Ila Patnaik. And over to you, Rajeswari.
Thank you so much. And is my screen and presentation now?
It's up.
Fantastic, fantastic. So thank you so much. And I want to thank the organizers for giving us the opportunity to present this work, which was, of course, done in a record-breaking speed. And it's co-authored with Ila Patnaik of NIPFP, who's also there in the panel today. I want to start by showing this graph of the volatility of the rupee-dollar exchange rate. And this is the annualized monthly standard deviation of the nominal exchange rate from roughly 2000 to the end of 2020. And the reason I want to start with this is that if we just look at the graph of the volatility of the exchange rate, and I've put the average volatility on the top, which is 5.34%, we can't really say anything about what currency regime the rupee was in at any point of time. I mean, we can see that there are some periods when the volatility was low, some periods when the volatility went up significantly, but beyond that, we can't really comment anything about the regime per se. And that is exactly what we plan to do in this paper, which is we use a data-driven analytical framework to decipher India's exchange rate regime. And I'll talk briefly about why there is a need to decipher from the data, so to speak. What is exchange rate regime? An exchange rate regime depends on how a country's currency is managed with respect to other currencies. Very simply put, there are three main types of regime: a floating, a fixed, and a managed floating. So the most of the developed countries of the world, they are in the floating exchange rate regime, where the central bank does not intervene in the currency market. There is no use of monetary policy or capital controls. Exchange rate either. Then on the other extreme, there is, let's say, a country like Hong Kong, which has a fixed exchange rate regime or a parity with the dollar, where the Hong Kong central bank use the monetary policy to maintain the parity. It'll be great if everybody can be on mute. Okay, so, and most of the emerging market countries fall somewhere in between, and they have, there's a wide variety of terminology, of course, but by and large, they all have what is called a managed floating exchange rate regime, where the central banks intervene from time to time in the foreign exchange market. India's de jure exchange rate regime falls in the third category, and I'll talk about why I'm harping on the word de jure. In 1993, we officially moved to a market-determined exchange rate, and this was in part of the liberalization and deregulation reforms that were initiated in the early 1990s. So part of the reform was a move towards an exchange rate that would no longer be pegged to the dollar, but instead that would respond to market forces. This is a graph of the nominal rupee-dollar exchange rate from Jan 1993 to April 2021. And you can see that over this very long period of time, of course, there has been a fair movement in the exchange rate. I mean, it's gone from roughly 29 to 74. It has depreciated very steeply, and there has been a lot of movement. So by looking at these graphs, we can probably say that the regime has been, maybe it's like it's floating regime. But that, again, does not really say much about what has been going on during many of the sub-periods during this long window, because it is not enough. I mean, we can't just jump to a conclusion that India's rupee has been in a floating regime by looking at this graph either. There is a difference between a de facto and a de jure exchange rate regime. So the de jure regime is something that is announced by the central bank. So on a de jure basis, India moved towards a market-determined exchange rate in 1993. But there is research in the seminal paper by Reinhardt and Rogoff in QJE in 2004, which showed that the de jure exchange rate regime of countries often differs from the de facto regime. So for the de facto exchange rate regime, simply looking at the level of the nominal exchange rate or even the volatility, as I was just showing, will not convey the full picture. The reason is that the actual exchange rate that we observe, it is an outcome of both macro financial shocks or other shocks that the economy is facing, as well as the intervention policy or the currency policy of the central bank. So the actual exchange rate that we observe de facto is a combination of these two. And it is therefore very important to look at both of these aspects, uncovered from the data, what is the de facto exchange rate. And the reason one needs or researcher needs to uncover from the data is that most of the central banks of emerging market countries, including India, do not transparently disclose what is the exchange rate regime. And hence this dichotomy, as Reinhardt and Rogoff pointed out very early on in the early 2000s, that there is this dichotomy between a de jure exchange rate regime and a de facto regime. So for example, while India moved towards a market-determined exchange rate regime in 1993, we know from the data that the Reserve Bank of India, India Central Bank, actively trades in the currency market with the officially stated goal of containing volatility. So this is a graph of the total volume of sale and purchase of dollars by the RBI denominated in USD billion. And what we can see is that right from 2000 till 2020, there has been a very active intervention by the RBI in the currency market. The blue bars show the dollar purchase, the total amount, and the red bars show the dollar sales. And there has been roughly speaking, one can see that there has been more dollar purchase than dollar sale, but either which way, there has been a lot of intervention by the RBI in the currency market. So right away, there seems to be this difference between de jure, what was announced, and de facto, what is actually been going on. But however, there is no central bank document per se, which transparently discloses the exchange rate regime that the rupee has been in any given time period, which is where the importance of using a data-driven framework becomes very critical. The existing literature, for example, IMF has this annual report which classifies India's de jure exchange rate regime as managed floating. There was a lot of work done pre-2008 in classifying India's exchange rate regime. And this pre-GFC literature, I've mentioned some of the papers here, they classify India's exchange rate regime as a de facto pegged exchange rate to the dollar. What we do in this paper is not only do we extend the sample period till the most recent time, we also combine two different strands of literature, namely the exchange rate regime literature and also the exchange market pressure to measure India's currency regime. And I'll just talk about why it is important to combine these two strands of literature and what additional value added we get or additional insights we get when we combine these two strands. So specifically, what do? We decipher from data what was India's exchange rate regime from 2000 to 2020. Was it just one single regime, or is it possible to divide it into structural break dates? And what did that regime look like? And also, we analyze the regime through the novel angle of exchange market pressure index. So we bring together these two in one paper. And the reason this is important is because the exchange rate regime literature focuses on the observed changes in the currency or the actual changes in the exchange rate. And as I was just mentioning earlier, that the observed change is a function of both shocks and central bank policy. Just by looking at the exchange rate regime literature or applying some of these methods, we can't comment anything much about what was the shock or what was the policy management like. And there, if you bring in the exchange market pressure and there's an additional layer on top of that, then we can understand the role of the shocks. And also by looking at how EMP was managed, we can comment on how much of this observed change was determined by policy. So combination of looking at the ERR methods and the EMP estimation gives us a very comprehensive picture about what was going on with the exchange rate, what was the regime like, what kind of shocks were being faced by the exchange rate, and how were the shocks managed by the central bank. And of course, we have done this for India because it's a very interesting case study for us, but this can be done for any emerging country as well. Why is it important to measure exchange rate regime? Well, apart from the fact that, of course, the central banks of EMs like India, they do not disclose transparently, and therefore one has to decipher from the data. The reason it's important, of course, is there is the most important, the open economy, macroeconomics principle of impossible trilemma, that a country cannot successfully exercise monetary policy independence and also try to stabilize the exchange rate if it has an open capital account. So there is evidence that India has been gradually liberalizing its capital account over the last few years. And we also know that India has adopted inflation targeting in 2016. So that means that there is an important question about this third vertex of the trilemma, that what is happening with the exchange rate. And as I said, since we don't have much information about the exchange rate, that is why it becomes important to measure the exchange rate regime using data to understand that while capital account openness has been increasing and inflation targeting has been put in place, to what extent exchange rate has been stabilized during this period of time. So moving on to the methods. Now, in the ERR literature, there is this sort of the gold standard of using a linear regression method that was popularized by Frankel and Way in 1994. And the equation 1 summarizes what they did and what many, many papers after that have done, which is that they use the returns of the target currency. In our case, it is the Indian rupee, normalized in terms of a numeraire. And we have used the New Zealand dollar because it's stable and is not something that is being manipulated or managed by the central bank. So we express the INR in terms of the New Zealand dollar. And the idea is that the equation 1 will show to what extent the YT, which is the target currency, is managed or is floating vis-a-vis a basket of other currencies. And for our purpose, we look at US dollar, the Japanese yen, euro, and the British pound, which is the most important floating currencies of the world. And the way to use this regression framework to understand the exchange rate regime is that if the rupee is pegged to the dollar, then the corresponding estimated beta for the US dollar will be close to 1. And all other estimated beta coefficients for the other currencies will be close to 0. On the other hand, if the rupee is pegged to this entire basket of currencies, then the beta values for each of these currencies would reflect the corresponding weight in the basket of currencies. And if the rupee is not pegged to any of these currencies, it is relatively in a floating regime, then all of these estimated beta coefficients will differ from 0. And they will end up reflecting the true trade and financial linkages of India with these countries. So that's how the beta value gets used to interpret the exchange rate regime. In addition, the R squared of this regression also has a very important role to play. If the exchange rate flexibility is low, then the R squared would be very high, because the idea is that much of the YT is being explained by the exchange rates on the right-hand side. On the other hand, if the exchange rate is highly flexible, meaning not much of the variation in YT is explained by the exchange rates on the right-hand side, then the R squared would be relatively low. Now, as I said, there's a large literature that has sprung up on the basis of the Frankel and Way regression since 1994, and I've just mentioned some of these papers. However, over the last few years, there has been a significant methodological innovation that was done by Zailis, Patnaik, and Shah, where they use the Frankel and Way regression model for estimating structural breaks in exchange rate regime. So while the Frankel and Way regression can be estimated over any period of time, it's a priori difficult to know that what is the correct window over which this can be estimated, because we don't really know the regimes a priori, neither do we know at what point the central bank is intervening, what point the shocks are hitting it. So what the Zailis et al. Paper, the ZSP paper, they do is that they use this Frankel and Way linear regression model, but they also answer some of these questions, which is that, is the relationship between the YT and the XT stable over a period of time, or does it continue to remain stable when there are new observations, new data coming into the picture? And lastly, when and how the estimated regime changes, right? So when do the parameters start becoming unstable? And they use that to date the structural breaks in the exchange rate regimes. And also very important innovation that they bring to the table is that while the Frankel and Way regression talks about the R squared, it does not talk about the error variance, which is a very important parameter. Because if the exchange rate flexibility is changing, then the error variance will also change. So that is exactly what the Zailis et al. Paper do, is that they consider the changes in the error variance to analyze the exchange rate regime flexibility. Right? So basically that means that if the exchange rate is in a more flexible regime, then the error variance will go up. And conversely, if it is in a sort of a pegged regime or a managed regime, then the error variance will go down. So what we do is we use this methodological innovation that has happened over the last few years, and we apply that to the Indian data and see what we can uncover about the exchange rate regime. So this is a table that shows the break dates of the regimes from 2000 to 2020. And let me very briefly take you through this table. So on the first column, you have the different regimes, and there are 4 regimes that we find from the data. The first one, 2000 to 2004, the rows across the different columns, they show the estimated beta coefficients of each of the currencies on the right-hand side. And then we have the sigma, the error variance, and the R-squared. So what we find is, for example, in the first regime, which runs from 2000 to 2004, the estimated beta coefficient of the US dollar was the highest. It was close to 1, highly statistically significant, whereas the beta coefficients of the other 3 currencies were very close to 0. And this is exactly what I was explaining earlier, that this indicates that during this time, the rupee was in a relatively tightly pegged regime to the dollar, which also is corroborated by the value of the R squared, which is very high, and the error variance, the sigma, which is relatively is the lowest in the sample. Then we move on to the next regime, which is 2004 to 2008. Now the beta coefficient of the dollar comes down in size. The yen also becomes important. More importantly, the R squared, it goes down, which means there is a relatively greater flexibility in the exchange rate in this regime, which is also shown by the fact that the error variance or the sigma goes up. Then we move on to the post-GFC regime, which is 2008 to 2013. Once again, it's the beta coefficient of the dollar is even lower, it's the lowest in the sample. The R square is also the lowest in the sample, and the error variance is the highest, indicating that this was one regime out of the 4 when the rupee exchange, the exchange rate was sort of in a flexible regime, relatively the most floating regime that we can find in the data. And lastly, we have the 4th regime, which runs from 2013 onwards till now, where we find that the beta coefficient of the dollar has gone up again slightly, and the R squared has also gone up relative to the preceding period, meaning that the flexibility in the exchange rate has gone down somewhat in comparison, and it seems to be relatively more managed now than it was in the immediate post-GFC regime, also corroborated by the lowering of the sigma value. So the data shows us that there are 4 de facto exchange rate regimes in India when we look at from 2000 to 2020. Right? So we have a 2004 break date, we have a 2008 break date, and we have a 2013 break. Now, this is again the same currency volatility graph that I had shown earlier, except now I have put the vertical bars demarcating the exchange rate regimes. I've also put the average volatility of the rupee dollar exchange rate on top of every regime. As you can see that exactly corroborated with by the R square and the sigma values, the rupee dollar exchange rate volatility was the lowest in the first regime, which was 2.24%. It was the highest in the third regime, 8.6%. So this was the regime where the R square was the lowest, sigma was the highest in that Frankel and Weyl regression framework, implying that this was when the rupee came closest to being a floating regime. And then we have the last regime where the sigma comes down to 5%, again, very close to the second regime, implying that there's more management of the exchange rate happening in the last regime. So now I want to talk about the exchange market pressure. So EMP is the pressure on the exchange rate. It's a very old concept that has been calculated, estimated in innumerable papers. It is either resisted through FX intervention or it is relieved through movements in the exchange rate. Right? And once again, I've mentioned some of the papers. There are many more about different measures of the exchange rate, exchange market pressure. Primarily, the measures are, it's a combination of change in the exchange rate and change in reserves, and different permutation and combination working on these 2 variables. And the reason why exchange market pressure very nicely combines in the ERR literature is because the pressure that the exchange rate faces and the manner in which it is being absorbed, or the manner in which the central bank responds to that pressure, becomes very relevant in this context of exchange rate regime. As I was saying earlier, that if the currency is in a floating regime, let's say there is a shock and the exchange rate is fluctuating in response to the shock, if the central bank lets it float, that is basically the floating exchange rate regime. On the other hand, if there are shocks materializing and there is pressure on the exchange rate, but the central bank intervenes in the foreign exchange market, that would be a more managed regime or even a pegged regime. And of course, the central bank can respond either using forex intervention or using monetary policy or using capital controls. In this particular paper, we have primarily looked at foreign exchange intervention, for subsequent research, one can always look at the role played by monetary policy and capital controls as well. So innovation in EMP methodology has also happened over the last few years, namely the Feldman-Patnaik Shah paper, which was published in the JIMF in 2020. They calculate the EMP as the sum of the actual change in the exchange rate that takes place and sort of an estimated counterfactual that the change that would have occurred in the absence of any FX intervention. Right? So the pressure is not only the actual change in the exchange rate that we get to observe, but also there is some change in the exchange rate that we're not observing because the central bank has responded in a certain manner. And they come up with a very cool way of estimating the counterfactual, and together that becomes the EMP index. And this EMP index it's a relatively statistically very sophisticated measure. It also allows us to quantify what share of exchange of EMP is absorbed through FX intervention and how much of the EMP is being relieved through exchange rate change. So again, very nicely that fits into the description of exchange rate regime as well. So the equation that they estimate, without going too much into the technical details, is the equation 2, where EMP is the sum of the actual change in the exchange rate plus a phrase rho TIT, where I is the actual intervention in the forex exchange market. This rho is the estimated counterfactual. So it's a percentage change in the exchange rate that can be prevented through a $1 billion FX intervention. So this is the counterfactual that they're estimating. And together, that second term gives an idea of how much the exchange rate would have changed if the central bank did not intervene in the currency market. The EMP value, it is expressed in units of percentage change in exchange rate, another innovation or improvement one can say, because many of the EMP measures in the literature do suffer from unit problems. In their case, the EMP is expressed as percentage change of exchange rate. A negative EMP denotes a pressure on the currency to appreciate, and a positive EMP is a pressure on the currency to depreciate. And very easily from this equation, we can find out how much of the EMP was absorbed by exchange rate change and how much of the EMP was absorbed by intervention. This is a graph of the exchange market pressure index using their method, the Feldman et al. Method from 2000 to 2020. Once again, I've juxtaposed the exchange rate regimes in this graph and put the average values of the EMP index on the top. So very quickly, what we see is in the first regime, we have an average EMP of minus 2.56%, implying that there was a pressure on the currency to appreciate. Then in the next regime, it goes up to minus 3%. So the pressure on the currency to appreciate goes up even more. And that flips completely after the global financial crisis, understandably so. A lot of emerging market countries faced a depreciation pressure, and the rupee dollar exchange rate also did the same. The EMP becomes a positive and average 0.7%. And in the final period, once again, the EMP turns negative, implying that on average, there was a pressure on the rupee to appreciate. And notice that the pressure on the rupee to appreciate in the last period on average is much lower than the pressure in the pre-GFC era. This is a graph of how EMP was managed by change of the exchange rate across the different exchange rate regimes that we find from the data. The red graph shows the percentage change in nominal exchange rate against the black bar of the EMP index. And right away, visually, one can say that in the third regime, and if you remember, I just said that in the third regime, in the ERR method, we find the R squared was the lowest, the error variance was the highest. This is when the rupee came closest to being in a floating regime. We also find that in the EMP method, that majority of the EMP was released through change in the exchange rate. In contrast to, let's say, the first two regimes, when the percentage change in the nominal exchange rate was not that much, or even for that matter in comparison in the last regime. This is the other side of the coin, where we find that in the third regime, much of the EMP was not really absorbed by intervention in the forex market. So here the blue line shows the net spot market intervention in dollar billion. And in contrast, we see that in the first two regimes, much of the EMP was absorbed through intervention in the foreign exchange market, also similar in the last regime. So this story, that's why the EMP and the ERR fit so nicely together. This story perfectly corroborates what the finding was from using the innovation on the Frankel and Weyl regression, that we have 3 out of 4 regimes where it seems that the EMP was absorbed through foreign exchange intervention, and 1 regime where the exchange rate was mostly floating. And of course, as a result of the central bank's intervention in the currency market, primarily, you can see from this graph, primarily to buy dollars when the pressure on the currency was to appreciate, the reserves have increased steadily over the last 20 years. This is the table that summarizes what the EMP was like and how the EMP was managed across the 4 regimes. So let me quickly run through it in the interest of time. So I want to draw your attention to, let's say, the first regime where the average EMP pressure. So here the EMP is reconstructed using intervention data. So the graph that I showed earlier was EMP using reserves data. And now I'm basically reconstructing the EMP using intervention data, because we can then nicely tease out what was the share of the intervention. And of course, the results won't really change in any way if we use reserves. So in the first regime, we have an average pressure on the currency to appreciate. And then we see that the actual change in the exchange rate is very small, is minus 0.005%. So the exchange rate appreciates by very little, despite a very strong pressure to appreciate. And that's perhaps because the Reserve Bank of India, so these are all average numbers during the regime, there was a significant intervention in the forex market to buy dollars, and also reflected in the share of the intervention being very high. So I wouldn't pay too much attention on the signs of the share, which may seem odd, but that's just a technical construct. It's more important that the relative share of the intervention was very high. In contrast, in the third regime, which is when the pressure on the currency was to depreciate, the exchange rate depreciated quite a bit. This was the first time when the central bank turned a net seller of dollars in the currency market, and the share of the exchange rate was the highest in our sample period. And in the last period from 2013 onwards, it's very curious that the pressure on the currency was to appreciate, minus 0.5%, but the exchange rate actually ended up depreciating on average. And this can only happen if there was a very excessive intervention by the central bank in the currency market. We do find that the central bank bought a lot of dollars in the spot market. But of course, we don't see that as much in the share. But that is also because this was not only spot market intervention done by the central bank. There was also a lot of forward market intervention that happened during this period of time. And that is something that we can't incorporate in the EMP measure, because the way the EMP index is constructed, we can only use the spot intervention, is the actual data that we can see. On the forward market, we don't have a lot of data from the central bank because there's a lot of opacity about how much forward market intervention actually happens. Very quickly on the transition across exchange rate regimes, I don't want to dwell too much on it. It's all there in the paper. In 2004, the first break date, the Reserve Bank of India ran out of government bonds to sterilize FX intervention. There was a lot of capital inflows coming in. The RBI was trying to sterilize, but the sterilization cost was becoming too high. By early 2004, the investors believed that the rupee was becoming a one-way bet, because the RBI would not be able to sterilize the intervention anymore, and it would not risk inflation. So it would just become unsterilized intervention, at which point the RBI would just give up and let the rupee appreciate. As a result, a lot of capital inflows increased even more, and the RBI basically didn't have a choice but to let the rupee float against a basket of currencies. So from a tightly pegged regime to the dollar, after 2004, the rupee was managed against a basket of currencies, what we also saw in the regime method, the results. Then in 2008, of course, there was the liquidity crisis in Bear Stearns. This was a precursor to the problems of that led to the collapse of Lehman Brothers in September. For most of the EMs, including India, this was the start of a pressure on the currency to depreciate. And we find that the ERR shifted from being a basket peg to one with greater volatility, meaning that the RBI permitted the rupee to depreciate, possibly because it could not defend the rupee anymore, because defending the rupee would also mean losing a lot of foreign exchange reserves. And there is literature that shows by Joshua Eisenman and others that most EMs around this time were characterized by the fear of losing reserves rather than the fear of floating. And then we come to 2013 November, where this was basically the taper tantrum episode, which started in May 2013 because of the QE taper announcement done by Ben Bernanke. There was a big depreciation pressure on the rupee. RBI squeezed liquidity. The short-term rates sort of went up by more than 400 basis points. There was a very active currency defense, and the ERR went from being a floating in the preceding regime to an actively managed one. And as I was just saying, that there was both spot and forward market intervention during this last period that we see. Now, one thing that I want to highlight here is, which I found very curious, is that while in the paper we have done a lot of discussion about the macroeconomic conditions for every regime to understand what was happening, we do also find that the currency regime do not really seem to be correlated with the macro conditions. It is not like there is a similarity across macro conditions between two regimes where the rupee was relatively managed. But what we do find instead is that the exchange rate regimes instead seem to be correlated with the tenures of RBI governors. And this is something that I'd also found earlier in earlier research with monetary policy. So this is something that I found at least very fascinating, that every time that there is a change in the exchange rate regime, there is also a change in the tenure of the RBI governor who's in power. We have 2004, 8, and 2013, and that just jumps up from the data itself. Lastly, I want to end with this last 1 year. Of course, there's been the year of the pandemic. What has happened in the EMP and the ERR, what we find from the data is that there was a lot of pressure on the rupee to appreciate because India, for the first time after 17 years, had current account surplus, not because of exports increasing a lot, of course, but because imports fell a lot. And also, India has been a very attractive destination for foreign investment. So, combination of this big pressure on the rupee to appreciate, on average, we find the EMP in the last 1 year from April 2020 onwards was close to minus 2%. But however, the average appreciation of the rupee was only 0.2%. So the exchange rate actually appreciated by very little compared to what the pressure was. And that was, again, potentially because RBI was a very active participant in the forex market. It did a net purchase of $70 billion between April and March 2021. And we do find that the pandemic is part of the last regime, which started in November 2013, which is when the rupee has been actively managed, both in the spot and in the forward market. So this is my last slide. We find, this is just summarizing the results of the paper, that using a data-driven analytical framework, we find that India witnessed 4 exchange rate regimes since the advent of the market-determined exchange rate in 1993. In only one of the 3 regimes, there was pressure on the rupee to depreciate, and we find the RBI let the rupee depreciate, resulting in a relatively freely floating exchange rate regime. In the remaining 3 regimes, the pressure on the rupee was to appreciate, and the RBI intervened to buy dollars and sell rupees. In the market, reserves went up, and EMP was absorbed largely through foreign exchange intervention. This also holds true during the last era, which is what is currently on, which covers the period of inflation targeting. And that can, in the impossible trilemma framework, that can potentially conflict with an inflation targeting objective if the central bank is also trying to intervene in the currency market to stabilize the exchange rate, even as we have an open capital account. So I want to end with this, and of course, very happy to take questions and listen to the discussants' comments. Thank you so much.
Great. Thank you very much. And thanks for staying with the time. Let us move now to the first discussant, Poonam. Floor is yours.
Yeah, just a second, putting up my... so thank you very much for this paper, Ila and Rajeswari. It was a very interesting paper to read. And it was particularly interesting because I could then also relate it to some of the work that I have done on this. So the main points that were made in the paper, of course, are that India manages its exchange rate, or in a way it stabilizes its value. It does so by actively using reserves, and it was shown convincingly in the paper. My quick reaction is, so what? But I'll wait for my detailed comments in a minute. India deviated from this practice during a period 2008 to 2013. And recall that in 2013, India was one of the countries which was most impacted by tapering talk. So one questions whether the fact that it did not manage its exchange rate or let it appreciate resulted in that impact. The paper also makes a very important point that managing exchange rate and reserve policy that it has done so far would be difficult under the current inflation targeting framework. And it cautions that if an external capital flow reversal event occurs, such as the tapering talk of 2013, it may have very few options left under the new inflation targeting framework, but to deploy capital flow measures or capital controls. So I actually make about 5 points in my comments. As soon as the slides go down. First point is capital flows. So the paper is somewhat silent on capital flows to emerging markets. And why do the emerging markets therefore have to do what they do? There is plenty of evidence out there which shows that capital flows are fickle anytime, anywhere. And they're fickle in 2 ways. First, there are episodes of surges when whether a country has absorptive capacity or not there can be a surge of capital inflows driven mostly by external events. It could be a risk-on sentiment, it could be global liquidity, it could be, of course, Fed's monetary policy and so on. When these surges happen, countries experience exchange rate appreciation. And these surges, of course, do not last. And they're followed by episodes of reversals, which can be of different kinds. Earlier, we used to have sudden stops. Now we have sudden pauses, and we have emerging market sell-off episodes, the kind we had in 2013, the tapering event, but also in 2015 and 18. These emerging market sell-off episodes have become actually quite frequent. What happens in all this is that there is strong co-movement of exchange rate and financial markets. And of course, surges, as I said, result in large appreciation of exchange rates. And when reversals happen, they are followed by steep depreciations. Then the question is whether an emerging market is served well under such a situation when there are such large movements in exchange rate, and these are all due to external factors. So we had done some analysis of the tapering event, Barry, Eigen, Green, and I, in early 2014. And we actually correlated the impact during that event to what had happened to emerging markets in prior years. Some of the correlates, the very strong correlates were that countries which had received large volumes of capital flows prior to 2013, countries in which exchange rates had appreciated, resulting in large current account deficits, actually had the larger impact of the tapering. The larger reversals of capital flows, larger impact on the exchange rate and financial markets. So India actually was among the fragile five, as we all know. So India, just like other emerging markets, most other emerging markets, has managed its exchange rate policy. It is among countries which practice a managed float. And India, just like other emerging markets, modulates large variations in exchange rates without targeting a specific level, and it uses reserves in doing so. So in this right-hand side slide on reserves, there is a unique period, as Ila and Rajeswari mentioned, between 2008 to 2013, when exchange rate policy was quite passive. Overall, there are very few safety nets that emerging markets have to insulate themselves from these bouts of surges and stops, and from these trends, these exchange rate appreciations and sharp depreciations. We actually looked at it in another paper, which we presented at the IPF in 2015, and we discussed this issue in some detail. That, you know, the other safety nets that one may think about, such as the swap lines, they are mostly unavailable, untested, and ineffective. And we do present some analysis in that paper. IMF's contingent lines have not provided a credible alternative either. So all that emerging markets have to insulate themselves is reserves, and to use them in a way that they can modulate their exchange rate movements, but also insulate themselves from these unavoidable capital flow and reversal episodes. So India does maintain a safe level of foreign reserves. In fact, if anything, its pace of reserve accumulation and level of reserves is comparable to other countries, as the previous slide showed. Now I move on to what do the countries do when they have a capital inflow or outflow episode. What kind of policy toolkit do they have that they can rely upon? And this is from a 2017 paper. It's a World Bank working paper. Didn't have the time to send it out to the journals. In this paper, we actually look at quite a broad variety of policy tools. We look at capital flow measures. We divide up capital flow measures on resident flows, non-resident flows, inflows, and outflows. Those are the first four columns. And other policy tools, of course, are monetary policy as traditionally practiced, which is interest rate, macroprudential regulations, exchange rate, and forex reserves. So countries in general divide up the burden of sharp increases or declines in capital flows across the last four measures. which is they let their exchange rates react. They do use reserves, accumulating or using them as the case may be. They use monetary policy and they use macroprudential regulation measures, but not so frequently. So where does it all take us? So when Rajeswari and Ila talk about that if a tapering-like event were to happen, India will not have any policy options. The point I'm making here is actually the policy matrix available to emerging markets is much broader than is implied in the trilemma framework. And in fact, if a tapering-like event were to happen again, the policy choices include exchange rate modulation using reserves, interest rates, liquidity measures, cash reserve ratio, macroprudential measures, and very importantly, communication. All of these were put to very good use in 2013, when though India was impacted very sharply, it also managed to come out of it relatively unscathed. And it's because of this wide variety of policy choices that were used. One policy measure that was used at the time and is not advisable, in my view, is capital flow restrictions in the midst of a sell-off episode. This is something India did experiment with, and in my view, it kind of backfired. So when we talk about capital flow measures, there are two ways to talk about it. One is a more structural policy tool, which is capital account openness gradually, or not opening it gradually, really. But once a sudden stop or a sell-off event happens, closing capital flows at that time can backfire and can get an overreaction from the market. And in the data actually that we saw, the paper I just mentioned, we saw that if anything, capital inflows are further liberalized during such episodes of sudden stops. There are very few cases when they are actually reversed. And this is exactly what happened in 2013 when India played with them. This is just an example of some of the commentary that was attracted at the time. Is India going to do a Malaysia? Is more to come? Does it smack of desperation, etc.? So it just supports the point that I'm trying to make, that capital controls during an event is not necessarily a good idea. What if anything changes during the inflation targeting? In fact, my reading of the literature is that exchange rate is a bit less volatile during an inflation targeting framework. And I attribute it to low and more stable inflation, which means that inflation does not translate into nominal exchange rate movements. It could also be due to policy credibility, and just simple charts to show how these variables have behaved in India during the inflation targeting period. Nominal exchange rate, real exchange rate, use of foreign reserves is more modulated than in the past, and simple regressions can actually pick up a statistical difference as well in post-inflation targeting versus the pre-inflation targeting period. I would also urge the authors to cite and look at the institutional view of the IMF, which actually does support the use of reserves in the kind of conditions I mentioned, capital flows being totally externally determined, and if the other fundamentals are in place, then use of reserves is legitimate and it does work. And on the right-hand side, I just have a copy of an interview that the RBI Governor gave 2 days ago, and it's in the Business Standard. And it says that India's monetary policy will be driven by domestic considerations, and any volatility in the currency can be addressed with the vast foreign exchange reserves. And this is similar to the IMF's institutional view. So just to sum it up, emerging markets continue to integrate globally. The process is kind of irreversible, but in the process, they are exposed to volatility triggered by global shocks. Burden of adjustment, in my view, is shared better between exchange rates and reserves, rather than letting your exchange rates overreact each time there you are on one side of this capital flow cycle. The available policy matrix is actually wider than the traditional trilemma framework indicates, and it includes all these tools that I've written here. Using active capital flow measures during this period can backfire. Capital flow measures can be used more as a structural policy tool. And in any case, with lower and stable inflation and more market credibility, the need for intervention or the need to manage the exchange rate may be less rather than more during the inflation targeting framework. Thanks.
Thank you, Poonam. Next, we have Prakash. Prakash, could you put your slides up and go ahead?
Okay, thanks, Raghu. Thanks to Poonam and NCAER for the invitation to discuss this very interesting and informative paper. I think it succeeds in its task of providing a very thorough, data-based and analysis-based narrative of the exchange rate regimes that have prevailed in India over the last 20 years. I think the paper also does what a good paper in a policy forum should do, namely raise interesting questions that deserve discussion and further analysis. So two broad questions, of course, come to mind. First, did Indian policymakers, notably RBI, get it right over the past 2 decades? And then what should the policy toolkit be over the next decade? On the paper itself, as Rajeswari noted, it rests on previous two solid pieces of previous research. I would have liked to see in this paper more discussion borrowed from Feldman, Patnaik, and Shah of how this parameter rho is measured. So rho is the change in the exchange rate associated with a given intervention. And if you dig into the underlying research, you realize that the measurement of rho is quite a delicate art. So from Feldman, Patnaik, and Shah, you see that to estimate rho, you need to have countries first with have had both regimes. You have to make assumptions about the volatility of the exchange market pressure being similar across those 2 periods, and the fixed and the floating regimes have to be adjacent. So you can't have too long of a window of time or a break in between. So this, I think, makes it quite a delicate task. And I would have liked to see more acknowledgement of that in the paper and some robustness checks to convince us that these 4 regimes are indeed the ones that we should be focusing on. I also missed a discussion of whether there is sort of path dependence in the regimes. Is it the case that some shock triggers a change in the regime, but then the RBI sort of continues in that mode, even if there may be a need to adjust, or is it just a regime goes on until there is another large shock? Or as Rajeswari was suggesting in her presentation, though this is not in the paper, is it that when the governor changes, the regime changes? So as she mentioned, they do have a very interesting previous paper in which they show that monetary policy choices are correlated with who was in charge. And I think this begs a similar analysis. Now turn to the 2 big questions. Did India get it right? Of course, you're all aware that in the 50s and 60s, Friedman said we should go, just let the rupee go. And he said, look at Canada, they're doing it right. What is clear is that India remains far from Canada. The paper very nicely shows that the RBI has used a very complicated multiple targets, multiple instrument strategy. And the answer I think we want to know from the analysis is, in the end, does it help us to assess the strategy and the policy choices that were made? In a few slides, my approach, like Poonam's, will be to look at the cross-country experience to give some clues on that question. As I said, the paper itself is somewhat silent on the merits of what the RBI was doing. It has this just the facts ma'am kind of tone. And this is in contrast with the views expressed by some of the authors elsewhere. For instance, on the taper tantrum, Ila some years ago said the rupee is falling and India should let it, and had statements like the RBI has used these instruments in the past and the results haven't been pretty. So I would like to see a bit of a connection between the dispassionate tone of this present paper and just saying things happened and the RBI adjusted to these shocks using these different mechanisms, and the kind of passionate views expressed in op-eds and elsewhere. As I said, I will use the cross-country evidence to provide a window on whether the RBI was doing it right. Of course, the fact that all central banks were doing it is no guarantee that everybody got it right. There's a lot of groupthink in central banks, but at least it shows that the RBI was not going rogue. It was doing what other central banks were doing. I'll draw on a report that we just finished last year at the Independent Evaluation Office that looked at how countries have dealt with capital flow volatility. There was a lot of background work supporting the report that you can look at. We reviewed the experience of 27 countries and did some detailed analysis for 12 countries. And we found results that were similar to what Poonam showed, the Gupta and Massetti paper. What we found is that countries typically have used a combination of instruments. They have also used generally the full range of policy instruments. So it's not as though a country has said, I'm going to intervene and do nothing else. Fiscal policy and other instruments were also adjusted, the instruments beyond the ones that Ila and Rajeswari look at in this paper. So countries generally adjust in the right direction. Sometimes they cannot adjust fiscal or they choose not to, but they try to move all instruments sort of in the right direction. And then there are some differences across countries. We found that Latin America and Asia tends to rely more on macro-prudential and foreign exchange intervention, whereas emerging Europe seems to be more willing to let the exchange rate adjust. We also found that capital controls were not really used to avoid adjustment on other fronts. In fact, the use of them, if anything, was complementary. So this is a point also that Viral Acharya and Arvind Krishnamurthy have made in a recent paper on how EMs use instruments in a kind of multiple fashion, using them all to kind of bolster one another. I was also comforted to find that the results of our work are very similar to what Rakesh Mohan, from his extensive experience and own analysis, concluded recently in the EPW, namely that countries have basically practiced flexible inflation targeting. Foreign exchange intervention has been the rule rather than the exception. I'm quoting Rakesh here. Capital account management has been practiced to reduce volatility. A variety of monetary policy instruments have been used, not just the policy interest rate, and financial stability concerns have led to use of various macroprudential policies. One other point which came up in our discussions with countries and also in analysis, including at the IMF, is that in certain circumstances, exchange rate movements actually amplify shocks rather than dampen them in the face of volatile flows. So the reluctance to use them is not always just coming from sort of fear of floating necessarily, but actually a fear that this will make the situation worse. This is a kind of example from the work that I've been talking about. You don't need to look at the detail. What you need to know is that on the top, we looked at 6 different policy levers that could be used. And the purpose of the chart is simply to show you that all the colors are there. Namely, it's not as though a country said, I'm just going to use green, which is macro-pru, or I'm just going to use intervention, which is the yellow. Typically, over the last 20 years, this is an average across Asian EMs, all levers have been adjusted and generally in the right direction. So based on this, what should the policy toolkit be for the next decade? I'll conclude on this and use the conclusions of our own IEO report, plus the other IPF, namely the IMF's work on a so-called integrated policy framework. So our own report suggested that from the country experience and from the recent research, there is some support for preemptive use of capital controls in some circumstances. I agree with Poonam that once the episode gets going, controls can backfire and be counterproductive, but preemptive use in some cases can work. We give examples of such use for Korea, for Peru, and one particularly, I think, convincing example is Iceland in 2016. After they had got over the initial crisis and flows started coming back, the advice they got from the usual circles was, well, your surge isn't as big as it was in 2008-9. There's no need for controls. And they said, that's exactly the point. We don't want to wait till the surge gets as big as it did last time. We're going to impose some controls now and manage it now. And they got out of that episode because they did it in a sort of preemptive fashion. So I think that experience, as well as the kind of more long-standing use by Korea and Peru, is something that should be kept on the table for discussion. This is the preemptive use of capital controls rather than using them once an episode is underway. And the conclusions from the IMF's integrated policy framework so far are also pushing in this direction. And what they say is that the difficult trade-offs faced by policymakers warrant the use of multiple tools under certain conditions. The optimal policy combinations depend on the nature of the shocks. They do not take the form of complete reliance on exchange rate flexibility under all circumstances. And in the presence of frictions of the kind still prevalent in many EMs and LICs, there is a case for using a multiplicity of tools, including macroprudential and capital controls, to balance the risks. And precautionary reserve accumulation during normal times also provides a buffer that can be used. So let me conclude on this note. I look forward to further work in the area by these two authors. I think it will be good to incorporate monetary policy instruments and capital controls into the framework for measuring exchange market pressure. And I hope that this research will draw out the implications for the design of an overall strategy for the RBI. Like Poonam, I'm less worried about whether inflation targeting creates tensions, because I think that in practice, the RBI, as the interview with the governor showed, is likely to not become an inflation nutter, but to practice in flexible inflation targeting and keep other goals in mind. So I hope that the authors will continue to work on these issues and give us some guidance on whether India should remain far from Canada or it should listen to Friedman and just let the rupee go. Thank you.
Great. Thank you, Prakash. So Karthik asked me to give you my views before I turn it over to the broader discussion. And I will give the authors a little bit of time at the end to respond, though I think the key chart is the one which shows dollar sales and dollar purchases. And typically the RBI has done both in over short periods of time, suggesting it's not sustained unidirectional intervention. Rather, it is trying to reduce volatility without fixing the level. And that was always our statement, that this was not an attempt to fix the rupee, but to reduce volatility. Clearly, what we were more worried about was downward volatility in the rupee. We wanted to break momentum on the downside of betting against the rupee. After all, that was what actually happened in the taper tantrum, and was a traumatic experience for many who went through it. Why is momentum on the downside particularly worrisome? Because in a regime with limited credibility, these downside movements could turn into very sharp movements. I mean, think about two sources by which the momentum could turn into fundamentals and be sustained. One is on the fiscal side. The oil purchases at that time were hugely subsidized. And therefore, any fall in the rupee would convert into a larger fiscal deficit. And that, of course, becomes more problematic as far as the exchange rate goes, larger external deficit, larger fiscal deficit, and a downward movement. A second source of downward movement in the exchange rate, converting into fundamentals, converting into further downward movement, would be the corporate sector. Many of them have unhedged dollar liabilities. And of course, without a decent bankruptcy regime, you could imagine that downward movements in the rupee would result in corporate stress, which results in lower activity, which then verifies the fundamental that the rupee should be lower and creates a downward movement. Now, it's these kinds of worries that cause us to try and limit volatility. And it's not inconsistent with an inflation targeting regime if you believe that extreme volatility in the rupee will knock us off the regime also by creating dramatic surges in imported inflation, and then make it more difficult to maintain the regime, especially when you're moving into it in its early days. And Poonam has argued, I think rightly so, that we really moved into an inflation targeting regime somewhere in late 2014, early 2015, as we started bringing India into the target zone. Now, at the end of this paper, if you look at what the implication is, at least I understood the implication to be the third regime was the best, but that was also the regime that resulted in the most volatility at the end. And so the question is that the way to go? Now, I think one has to also be cognizant of the fact that if you're trying to reduce volatility, you do increase a variety of sources of moral hazard, right? So the obvious one is if you reduce volatility in exchange rate movements, are there people who come to rely on it? For example, corporates say it's not going to move much, so we're not going to hedge much. And that's absolutely true. And one of the downsides of intervention is it breeds more intervention. In an attempt to prevent those kinds of liabilities from increasing, you sort of have a regime which monitors how much corporations borrow in foreign exchange and limit that. And so I'm perfectly sort of in consonance with people who say intervention breeds intervention, be careful. And you have to be careful. The hope is that, ultimately you get rid of the need for managing the exchange rate in two ways. One is build credibility for your inflation targeting regime so that, being knocked off a little bit this way, that way, it doesn't matter because people know that you're going to stay with the inflation target. And that allows the rupee to get a fundamental of its own from the inflation targeting and nominal anchor, which is good. A second is if your financial system and your access to international capital markets is unimpeachable, and therefore people believe that movements in the exchange rate, etc., will not somehow impair your access. That also requires a different kind of credibility, a strengthening of the capital market institutions, etc. I mean, Poonam was exactly right when she said we need this reserve buffer to insulate ourselves because we have no friends. Even the European Union went to get swap lines from the Federal Reserve. We asked for swap lines. That's on public record. We didn't get them. The only person who helped us during the taper tantrum was Japan, a 50 billion swap line. And, we, after some time, didn't need it. They pulled it at that time. Contingent lines from the IMF have huge stigma associated. I can't see an Indian government going to the IMF and saying, I need a contingent line, even though, to the IMF's credit, it's said frequently, this shouldn't be a source of stigma. So when you have no external supports, you have to build your own supports, which is why we started building the reserve buffer. And why, during this period, the RBI governor can say we have 609 billion, plenty to take care of any eventuality. Let's not worry about it, right? So broadly speaking, I would say, you can tweak this regime at the margins, but it's worked for us. It's not the long-term regime that we should have. Hopefully, as we build credibility for inflation targeting, and as we strengthen our institutions, we can move away. The last point I want to make is that Poonam raised the issue of macroprudential tools. And we have been trying to build macroprudential tools. Of course, the external commercial borrowing monitoring is one part. But one of the tools we have created over time is the ability of families to take out money, right? And when we started this, we sort of integrated all the money they could take out, and it came out to 250,000 per family. Now I think it's 1 million. That I have always said is a macroprudential tool. We are going to allow people to take out money when the environment is reasonable, when we don't have exchange rate pressures, and when things tighten up, we will make it, we will limit how much can be taken out. It's sort of a tap on inflows versus outflows. Again, I buy Poonam's point that you shouldn't change the regime, but if you insist that something is a macroprudential tool to be opened up in good times and to be closed or at least tightened in bad times, that's a source of control over flows. Another source could be mutual fund outflows and mutual fund inflows, which we could use as a tap again. When times are good, let the outflows go. When times are bad, tighten a little bit. But let me stop there and say, and look for comments. Suman has the first comment.
I just wanted to test a couple of propositions. One is the paper, and I have to say this is based on the presentation of the paper, is the paper maintaining positively that there has been no real exchange rate targeting, which is sort of implicit in your comments, Raghu? And normatively, is it saying that that's the right thing to do? Because there is a strong constituency, including some people who are members of the Research Advisory Panel, who believe that what is behind India's poor export performance is the way the RBI has managed the exchange rate. So a factual question, that is there evidence or not evidence on real exchange rate targeting? Secondly, my sense is that the Brazils of this world, do believe in, don't have fear of floating, do believe that, as it were, a genuinely flexible exchange rate is is a valuable part of an inflation targeting regime. Admittedly, they've had it for 20 years. We've had it for 4. And they see it as a shock absorber. So again, I want a bit more clarity about whether the exchange rate in India is a shock absorber or whether we're not ready for that yet. And finally, the point that Raghu made on communication, which is, credibility in other dimensions. And my question is, given where we are on fiscal post-COVID, does the toolkit need to change? Thanks.
Great, Suman. Arvind.
Thanks to Rajeswari, Ila, Raghu. Part of my question was kind of asked by Suman. So the question I have is a related one, which is that, if you look at East Asian exchange rate policy after the global financial crisis, we know it was kind of asymmetric intervention, right? And there's a big debate about whether this was because of self-insurance, which kind of Raghu emphasized, or whether it was actually de facto mercantilism, don't allow the exchange rate to appreciate and keep your export boom going for a very long time. And, to varying degrees, of course, China did it in spades, helped by capital controls. Korea has done it, Taiwan has done it, Singapore has done it, and so on. So my question is that, the word competitiveness, and kind of this is the question about the level, targeting the level of the exchange rate, because although Raghu, you say, they were both, purchases and sales, I mean, the fact we've accumulated 600 billion gives you is unambiguous about, the fact that it's not one-sided at all. Of course, underlying capital flows could be different. So it's not one-sided. It's not a neutral intervention. And so how much of this, it's highly asymmetric. By the way, and I kind of agree with the policy quite a bit, because I do think you need to acquire reserves. But I guess my question is that, is it that you do have competitiveness concerns when running this, but volatility and self-insurance become ways of actually doing one thing but saying something else? Because it seems to me that East Asian exchange rate policy was completely asymmetric after the global financial crisis, which in a sense, what the evidence that Ila and Rajeswari show seem to be very similar after the taper tantrum in India as well. So the whole absence of competitiveness in the whole, in the presentation, the discussion surprised me a little bit when in fact, it seems to have been pretty important in what India and other East Asian countries did.
Ken?
Me unmute. I don't know. Okay. I just have a couple of comments on the paper itself. And in particular, Poonam raised one of these, I think, importantly, but I just wanted to touch on it briefly again, which is the absence of considering the importance of external shocks. That I think really goes a long ways towards understanding the response to exchange rate volatility and the use of reserves, which I would like to see the paper actually take that on more and discuss at least the literature and capital flows, but specifically maybe analyze them as well in this context. And as Prakash noted, in understanding the structural breaks, what's going on there between that and the measurement of exchange rate pressure as well as capital flows. The question and the issue that I'd like to raise is getting away from, it's really just maybe a little prissy, but getting away from the trilemma as the framework for talking about this. The paper is addressing the management of the exchange rate intended to reduce the volatility of the nominal exchange rate, and also talks about the conflict of that with inflation targeting regime. That's been addressed by others. But I want to just talk about that just a little bit more in theory and the nuance that's maybe needed to add to the paper. The trilemma as interpreted here is really concerning the vertices of that two-dimensional simplex that we draw. And that is the full monetary autonomy versus fixed exchange rate regime with an open capital account. That's not what's happening here. There's a limitation instead on the volatility of the nominal exchange rate, not necessarily a targeting of the long-run level or rate of depreciation for it. The second is that the full monetary autonomy, inflation targeting, right? And when we write down even maybe the most strictest of model, IGIDR and Gertler and Clarida, we'd find out that what we have is a trade-off between the output gap and the meeting the inflation target. Instead, right, what we have then is a trade-off. For example, if you have a supply shock, that's a trade-off. If we have a demand shock, there's no trade-off. Those are really strict models. They're not addressing, volatility and shocks that address just the inflation target. And so that, I think, needs to be nuanced much more, is that having the inflation targeting regime itself as a policy choice, adding another instrument in there seems to be something that central banks have done. And it isn't just that there's a lot of empirical literature out there looking at, for example, panel regressions, looking at that question. Inflation targeters do seem to have less volatility of the inflation rate, as Poonam noted from for the case of India, from a paper at the last IPF. And I think that that also carries over to some advanced economies. In fact, the Bank of England seems to choose its bank rate with the influence of exchange rate movements, and the Bank of Canada, that so many times, also seems to do that. I think that some citing of that empirical literature would be valuable, but getting away from this strict frame of the trilemma and talking much more clearly about, we're talking about volatility, and we're talking about centering perhaps volatile inflation rate as well. Thank you.
Great, thanks, Ken. Anybody wants to make a comment, please raise your hand. There's a raise hand function on the bottom of your Zoom screen that should do it. Karthik, you wanted to say something? I see no hand now. You're on mute.
Yeah, no, just a 30-second question, not to the panelists, but really, I guess, partly to you and Arvind, because when you mentioned the costs of volatility, the natural question is why we not let the rupee futures market develop as much to allow the hedging to happen. So my sense is that's still a very kind of nascent phenomenon where you have banks overseas running some versions of futures markets, but we don't really have an active currency futures market that will allow both, market expectations and hedging to take place. And just wanted to quickly understand the thinking behind shutting that down or not actively developing that.
I actually don't think it's shut down. It's very active. It's very present. In fact, our entire sort of, when we brought in money in 2013, it was actually by giving people a good deal on the futures rate. So it's an active market, but maybe I'm not conversant with it as much as I should be, and somebody else will have a view on it. But it's active. I don't think that we stopped that in any way at the RBI. Okay, so if there are no other questions, in the interest of time, let me turn it back to the authors. Lots of comments, lots of suggestions, and you have the, actually, let me just 1 second look at the questions on the chat. Okay, just a couple of questions you may want to take as you respond. One is from Ajit Ranade. Does India's accumulation of Forex, despite being possibly the only large accumulator with a current account deficit, create any additional vulnerability? Anant Narayan, should we look at movements in real effective exchange rate rather than nominal? And there is monthly RBI forward market intervention data. Any reason why only spot intervention was used? I guess that's in the paper. And so there are multiple other questions. I can't read them all. Please go ahead and address any of them that you would wish in your response, but please, you have 4 minutes.
Practically impossible to answer all of these in 4 minutes. So
pick.
Yes, I'm picking. So I'm going to select some of the questions which I think are very important to address. So combining Poonam's question of so what, and a lot of discussion on capital inflows, explaining why emerging markets like India do what they do, and then Prakash's point about why we are dispassionate about this analysis and not going into what the RBI should have done, or is it right or is it wrong? And I want to answer that by saying that the fact that we are not going into this normative judgment is a feature of the paper, not a bug. The objective of the paper is to analyze the data and to excavate and reveal facts about exchange rate regime and how EMP was and how EMP was managed. Because that itself, in the case of EMs like India, is a mystery, because it is not transparently disclosed by the central bank as to what regime the exchange rate is in at any point of time. And we sort of have to keep guessing by looking at different data like FX intervention, reserves, etc. So the objective of this paper squarely is to use the methods available to reveal the facts about the exchange rate regime. And I'm delighted that that has triggered a lively debate about what the central bank should and should not do, especially as we go forward and recover from the pandemic. And that is a very legitimate question, and these are complex judgments involving critical trade-offs, but that's not something that we want to get into this paper, because the first objective is to figure out what the RBI itself has been doing, which is not clear in and of itself. There was a question by, there was a lot of discussion about the toolkit, about what the RBI can or should do. Once again, we don't want to talk about it in the paper, but since there was a lot of discussion here, I just want to quickly say that I think the jury is still out there about what happened in the paper tantrum episode and what the repercussions were about the currency defense that were mounted. And we do find in the data that while India does have a lot of foreign exchange reserves, but when there were shocks and when there was a pressure on the currency to depreciate, we don't really see a lot of the reserves being used to defend the currency. We do see that other instruments were being used to defend, but not necessarily reserves per se, particularly in the 2008 global financial crisis aftermath. We don't see that reserves were being used at all. So what we were struggling to figure out from the data is that there is no unifying framework to understand what drives the intervention policy of the central bank. Now, is it volatility versus targeting? Again, combining comments of Arvind and others, we do find that there is evidence that by and large, the RBI has bought a lot more dollars than it has sold. So there is an element, very strong element of asymmetric intervention in the currency market, when the RBI is primarily stepping in when there is pressure on the currency to appreciate, and it is trying to prevent that by buying dollars and selling reserves, which also has led to selling rupees, which also has led to the reserve accumulation. We don't see that when there is a pressure on the currency to depreciate, the RBI is using these reserves which have been accumulated to defend the currency. So there does seem to be a one-sided intervention in the currency market to prevent the rupee from appreciating, perhaps because we have always been a current account deficit country, and an appreciating rupee is not necessarily something that is good for us. But we don't really know the reason. So there is no unifying framework to justify or understand what the RBI has been doing or why it does what it does. What jumps up from the data is that the three regimes when the RBI has intervened actively in the FX market are the regimes when there was a pressure on the currency to appreciate. And the one regime when there has been no intervention was when the currency was depreciating. And also on the targeting versus volatility question, I think the last regime, what the data shows up again is very, very important, that there was a pressure on the currency to appreciate on average, but the exchange rate ended up depreciating. So that can happen only when there is what is called more than leaning against the wind, when there is excessive intervention in the foreign exchange market, that there is so much of dollars that is being bought that rupee ends up depreciating in the end. And that again is not something that would happen if the objective was only to contain volatility. Even if there was a severe shock in 2013, after that, once inflation targeting was adopted, there wasn't really any severe external shock, but the RBI kept on intervening in the currency market, especially when there was pressure on the rupee to appreciate. That cannot be justified just by the simple goal of controlling volatility in and of itself. Going forward on the toolkit, again, as we see from the data of 20 years, reserves, although they keep piling up, are not necessarily something that gets used by countries, perhaps because it has increasingly become an indicator of macro strength, and therefore countries think twice before using reserves when there is a depreciation pressure. But many other things end up getting used, which can cause repercussions. For example, there are repercussions on growth if monetary policy is being used to defend the currency, and so on and so forth. A few questions about use of monetary policy versus capital controls. The analytical framework that we use, it is very difficult to incorporate monetary policy and capital
Rajeswari,
controls.
1 minute,
yes,
just so that we give the other panel.
So
Ila, you wanted to speak?
Yeah,
I'll just quickly
since we're running out of time, maybe I could have a couple of minutes to answer some of the discussions. And I thanks very much to Poonam, to Raghu, and to Prakash for their very useful comments. I think, we've had a different objective. And as Prakash said, we are only looking at the facts, ma'am. But yeah, that is true. We were there are a few unanswered questions about exchange rate regimes in India. So the first question we had was there a single regime? Do we see structural breaks? And what kind and where would we see the dates? We were curious about this question. We didn't know the answers when we began. In fact, we don't have governors in the picture because I don't particularly agree that it's because of governors. I believe that it's because of external shocks and not the identities of governors. So it was the 2013 taper tantrum that was the last one. And prior to that, it was the Bear Stearns and Lehman crisis. And prior to that was the very high external capital flows, which of course Poonam also mentioned, that there are high capital flows and there are periods of surges and there are periods of reversals, and in those determine what the regime should be like. So I think that RBI is usually trying to follow a very difficult balance, a very difficult path. I mean, you have pressures from, even now you have pressures from exporters. You have who don't want the currency to appreciate, and as Raghu correctly mentioned, there are balance sheet concerns. And while many of us, including me, would always say yes, we should develop markets more, but we do realize that at the moment they're not developed, so as developed as we might like them to be. And then so there are these moral hazard issues, and people do build up.
Ila, 1 minute. You have 1 minute.
I have 1 minute. That's fine. I'll finish in 1 minute. Yeah.
Okay.
So the questions we were asking was, were there breaks? And I think we very interestingly find that yes, there were breaks. Question 2, what were they driven by? And we find that they were driven by external shocks, which related to capital flows or global financial conditions. And 3, whether there was asymmetry in the response of the central bank. And I think that is something we were very curious to see. And we do see that when there is pressure to depreciate, we see much less use of reserves. We'll also try to strengthen the paper. We'll do the robustness check. We'll do path dependence. And I think, bring in more of strengthen the paper on the role of external shocks. So that is very useful. But the paper, I think we would still like to continue that the paper is not a paper about whether RBI did right or wrong, but a paper about measuring exchange rate regimes.
Well, thank you very much, Rajeswari and Ila. This is really a very interesting paper, and thanks for all the comments, and turn it back to you.